The IRS has a legal loophole that can wipe out $500,000 or more in capital gains taxes when you inherit property, and it's completely legitimate. Here's the scenario. Your parent buys a house in 1995 for $400,000. By the time they pass away in 2024, that house is worth $2 million. Normally, if you sold it immediately, you'd owe capital gains tax on that $800,000 profit. But under Section 1014 of the Internal Revenue Code, something remarkable happens. The IRS resets your cost basis to the property's market value on the date of death. That's called a step-up in basis, and research shows it's one of the most powerful tax strategies in the entire U.S. tax code, yet most people have never heard of it. Welcome back to Tax Shield Research. We're the Tax Shield Research team, and today we're breaking down the stepped-up basis provision, how it works, who qualifies, and why this matters for your estate planning. What exactly is stepped-up basis? Let's start with the fundamentals. Your cost basis is simply what you paid for an asset. When you sell that asset at a profit, you owe capital gains tax on the difference between your basis and the selling price. For example, imagine you bought Apple stock in 2010 for $5,000. Today it's worth $95,000. Your cost basis is $5,000. If you sell now, you'd owe capital gains tax on $90,000 of profit. At the long-term capital gains rate of 20% plus the 8% net investment income tax for high earners, you'd pay approximately $18,900 in federal taxes. That's a significant hit. Now, here's where stepped-up basis changes everything. If you hold that same Apple stock until you die and then your heirs inherit it, the IRS automatically resets the basis. Instead of your original $5,000 purchase price, the new basis becomes $95,000, the market value on the date of your death. This is called a step-up because the basis steps up to the current market value. This means your heirs could immediately sell that stock for $95,000 and owe absolutely zero capital gains taxes. The entire $90,000 gain simply vanishes. This is completely legal and completely legitimate. The real-world impact. Multiple case studies. Let's examine several realistic scenarios that demonstrate the magnitude of this benefit. Case study 1. The family home ***. Consider the Johnson family in California. In 1990, Robert Johnson purchased a property in San Francisco for $350,000. Due to California's real estate appreciation, that same property was worth $2.8 million when Robert passed away in 2023. His daughter, Maria, inherited the house. Scenario A without step-up. If Maria had inherited her father's cost basis of $350,000 and immediately sold the property for $2.8 million, she would owe capital gains tax on $2.45 million in profit. At the long-term capital gains rate of 15%, a federal rate, plus California state taxes of 3% plus the 8% net investment income tax, the total tax bill would be approximately $635,000. Scenario B with step-up basis. Because of IRC Section 1014, Maria's basis stepped up to $2.8 million, the fair market value on the date of death. If she sold immediately for $2.8 million, she would owe zero federal capital gains tax. Her total tax savings, $635,000. Case study 2. Commercial real estate ***. Consider Thomas Chen, a real estate investor who purchased a commercial office building in Austin, Texas in 1998 for $1.2 million. By the time Thomas passed away in 2024, the property had appreciated to $4.5 million due to Austin's tech boom. Thomas's son, David, inherited the property and wanted to liquidate it to diversify his holdings. Without the step-up basis, David would have faced capital gains tax on $3 million of appreciation. At the 20% long-term capital gains rate plus 8% net investment income tax, assuming he's a high earner, plus Texas has no state income tax, David would have owed approximately $788,000 in federal taxes. With the step-up basis, David's cost basis became $4.5 million. He sold for $4.5 $5 million and paid zero capital gains tax. Total tax savings, $788,000. Case study 3. Investment portfolio **. Elena Martinez had been a savvy investor for 40 years. Her investment portfolio, which she started with $50,000 in 1982, had grown to $2 million by 2023. This included individual stocks, mutual funds, and ETFs. Without the step-up basis, if Elena had liquidated her entire portfolio while alive, she would have owed capital gains tax on approximately $15 million in gains. At 20% long-term capital gains rate plus 8% net investment income tax, her tax bill would have been roughly $95 million. When Elena passed away in 2024, her heirs inherited the portfolio with a stepped-up basis of $2 million, the fair market value on the date of death. The heirs could have immediately liquidated everything for $2 million and owed essentially zero capital gains tax. The tax savings for her heirs, $95 million. How the step-up basis works mechanically. Now let's walk through the actual mechanics of how this works. Step 1. Determine the fair market value. When someone dies, the executor of the estate must determine the fair market value of all assets as of the date of death. This becomes the new basis for all inherited property. For real estate, this typically involves professional appraisals. For stocks and bonds, it's the closing price on the date of death. For small businesses, it may require a professional business valuation. The fair market value determination is critical because it sets the new baseline. According to the IRS, fair market value is the price at which property would change hands between a willing buyer and a willing seller, neither being under any compulsion to buy or sell, and both having reasonable knowledge of relevant facts. Step 2. File Form 8949 and Schedule D***. When heirs eventually sell inherited property, they report the transaction on Form 8949, Sales of Capital Assets, and Schedule D of their tax return. The key difference is that they report the stepped-up basis as their cost basis, not the original purchase price. Step 3. Calculate the capital gain. The capital gain is calculated as the sales price minus the stepped-up basis. In most cases where heirs sell soon after inheriting, there is little to no gain. Step 4. Report and pay taxes if applicable. If heirs hold the inherited property and it appreciates further, they would owe tax on the appreciation that occurs after the inheritance date. But the appreciation that occurred before the death is never taxed. Who qualifies for stepped-up basis? Stepped-up basis applies to any heir who inherits property from a decedent. This includes spouses and children, most common, other family members, non-family beneficiaries, charitable organizations. Essentially, if you inherit property from someone's estate, you get the stepped-up basis. It doesn't matter if you're the direct heir, a beneficiary named in a will, or even a beneficiary of a trust. Important limitations and exceptions. While stepped-up basis is powerful, there are several important limitations. The election exception for surviving spouses, under IRC Section 1014. If a surviving spouse inherited property from the deceased spouse within 1 year before the current decedent's death, and then that property passes back to the original owner's family, the step-up basis doesn't apply. This prevents married couples from gaming the system. Inherited IRAs don't get stepped-up basis. One critical exception. Inherited IRAs and retirement accounts do not receive a stepped-up basis. If you inherit a traditional IRA worth $500,000, you still owe income tax on withdrawals based on the original cost basis within that account. This is a major planning consideration. Property in community property states. In community property states, California, Texas, Washington, Arizona, etc. Community property received from a deceased spouse gets a full stepped-up basis. However, the non-community property portion doesn't. Foreign real property. As of the Skilled and Reliable Act provisions, certain foreign real property may not receive the same stepped-up basis benefits, depending on tax treaty provisions. The political controversy and future outlook. It's important to note that stepped-up basis is increasingly controversial. Many politicians argue it represents a significant tax loophole that primarily benefits wealthy families. According to research by the Treasury Department, stepped-up basis costs the federal government approximately $40 billion annually in foregone tax revenue. For comparison, that's more than the entire budget of the Department of Homeland Security. Several politicians, including President Biden, have proposed eliminating or significantly modifying stepped-up basis. Some proposals would require heirs to pay capital gains tax on appreciated assets, even if they haven't sold them yet. However, as of 2024, stepped-up basis remains fully in effect and available to all heirs. While future legislation could change this, it remains one of the most powerful legal tax strategies available. Strategic planning implications. Understanding stepped-up basis should influence your estate planning decisions. Hold appreciated assets until death. If you have significant unrealized gains, it may make sense to hold those assets rather than selling them during your lifetime. This allows your heirs to benefit from the stepped-up basis. Coordinate with your will and trust. Work with an estate planning attorney to ensure your will and trusts are structured to maximize stepped-up basis benefits for your heirs. Don't sell before passing assets to heirs. If possible, avoid selling appreciated property before passing it to heirs. Let them inherit it, receive the stepped-up basis, and then sell if needed. Conclusion. The stepped-up basis provision represents one of the most substantial and underutilized tax benefits in the entire U.S. tax code. For families with significant real estate, investment portfolios, or business interests, this provision can result in hundreds of thousands or even millions of dollars in